Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for Thursday, September 7th. We're recording a bit early today, but we've got a hodgepodge of stuff that we'd like to chat about for the future, what we saw last week. I'm here with Will. My name is Miles, and we'll be leading you through the podcast today. Will, what do you have to say?
What do I have to say? What do you have to say about performance over the past 7 days?
It
Because I'm
was
looking at, if you didn't own energy or the US dollar, you lost money.
Yes, it was poor across the board. S&P right there, smack dab in the middle, falling around 1.1% for the last 7 days. Couple of the main portions, kind of the flip side to that dollar that you just mentioned. One thing we're watching, and we'll look at the chart in a bit, but the emerging markets, developed markets down there towards the bottom, that's an interesting development that we're seeing from a strength perspective. So from a performance perspective, seeing those names kind of fall.
Yeah, I mean, rising dollar, that makes sense. It had a good week. International had a bad week. That definitely checks out. Something else I was looking at too is a lot of bond funds got hit pretty hard. Like the ag was down 1.3%. TLT, which is like a long duration bond fund, down almost 3% as rates ticked up a bit. So there's a lot of talk around those. There's some interesting like kind of risk reward setups, especially for TLT at like multi-decade lows. So not much to say on that today, but some things that we've talked about in the morning briefs.
Yeah. And then the other one that's down there in the bottom, and I think we can start here, is going to be the Russell 2000 for small caps. I mean, you put a
Yeah.
piece together in the report, Russell 2000 falling about 1.5% for the last 7 days, and they got killed recently, right?
Yeah, so Tuesday, like the day after you get back from Labor Day weekend, there was a pretty historic performance spread between small caps and like large cap benchmarks. You could have done a comparison versus a variety, but I did it versus IWM and QQQ. There was about a 2.2% spread. So the Qs outperformed IWM, which is a Russell 2000 ETF, by 2.2% in a single day, which is pretty rare. In fact, that puts it in the 97th percentile. So if you take all the daily spreads and rank them out in terms of percentiles, that was in the 97th percentile. So 97% of the time, that doesn't happen on a day-to-day basis. And we put a distribution in the report to just highlight how rare that was. Miles, you and I were talking yesterday, like not everything is an indicator. And I think as technical analysts, we kind of get that wrong sometimes, where if there's a data point that's rare, we're going to try to run forward performance off of it. So I did. And there's really not much to show, to
Yeah.
be honest. Like if you're looking not 95th percentile, those single days, there is a lot of clustering. And then you say, like, does that mean anything for small caps or the Qs going forward? It was pretty inconclusive. It was 50-50, pretty average returns.
And in that report as well, one thing I want to highlight is that chart of IWM, the representative for the small cap universe. We're going to take a look at. They've got a really interesting looking chart, right? You've got that old resistance, that sticky resistance that we had earlier this year at around 178 or so, broke through that, broke back into a positive trend. And then that 178 low 180s level really emerged as some new support. So that's classic technical analysis there, old resistance being new support. And now we're moving back towards kind of testing that range again. So if we do see some further underperformance from small caps,
Yeah.
like you mentioned, that could be a pretty interesting test.
Yeah, I would agree. That's a pretty key level. I would expect the Bulls to defend that pretty heavily. Where do you want to go from here? I know we got a bunch of other stuff on
Yeah,
the
I think the
docket.
one that makes the most sense is looking at the dollar, chatting about
Yeah,
that pretty briefly as you
yeah,
have that
go for it.
international equity strength. So we've mentioned pretty frequently over the last for forever. The dollar is one of the best trending assets that we have on the platform. We can see it typically, buy signals leading to more buy signals, sell signals leading to more sell signals. The adage goes, right, a rising dollar is probably bad for international equities. And also we've run some tests with domestic equities as well. Probably a falling dollar is better for the equity space in general. Nonetheless, we saw the US dollar post a buy signal recently, and it's encroaching up on its bearish resistance line up ahead. So an interesting development to watch out for, how that's going to impact emerging markets. We've seen them reverse back into a negative trend for EEM. So if we continue to see some deterioration there.
Yeah, I was looking at the US dollar too. It's at a pretty overbought level.
Yeah.
So there could be an exhale there. I think emerging markets would appreciate that. I'm trying to see. I mean, this is the most overbought the dollar's been since September of 22. That doesn't ring a bell as a super material time, but yeah, I mean, September of 22, that was just before the past bottom in October. So dollar's pretty extended. So I think you could see some type of near-term reversion, mean reversion. There's also a lot of resistance nearby for the dollar. Should you break back into a positive trend, given another buy signal, that would just further some of the macro implications. But yeah, but for now, that's something that we're watching pretty closely.
Yeah. And again, the impact that has on emerging markets, which have rolled over a little bit, and developed markets, which are holding somewhat resiliently, in at least comparison to the emerging market counterpart.
Yeah, I would agree with that. Completely different topic. I'll start with a more bearish point, then we'll get into some more positive things. One more somewhat bearish point would be the month of September. We've talked about that a lot. Historically, the weakest month for the market. You've probably heard it on the Today Show by now, them talking about this. But it's really the back half of September that gives people the most problems. So if you look at the past 30 years, the average back half of September return is like down 1, median's down 50 bips, and is positive 38% of the time. So that's the back half of the month. The first half of September is typically up 55% of the time, average gain of about 0.5%. So we're getting close to the back half of the month. We have like one more week, and I don't know if you can. It's of course not that clear, point market goes, but seasonality has been pretty good this year, so I would expect maybe some of that to continue.
It just feels so due, doesn't it? Like we're up for the market, 16.5%. And you're like, oh,
it does feel due.
We're rolling into the back half of September, and you're like, yeah, I could see us.
Yeah.
You could make the other argument too.
Yeah.
I mean, you and I typically bulls in general, and I think the majority of the market likes to claim to be a bull. But I mean, you could see it go either way. You're seeing technology continuing to remain strong. Participation is holding steady there. We haven't talked about our indicators today, but pretty much in the middle of the table. Over 50% of stocks.
So maybe the take would be that, I mean, Miles and I, we would probably agree that should you get some more exhales in September, that's probably going to be an adding opportunity to the market. Something else positive that I wanted to mention was, and Jamie put this in the report yesterday, about fixed income. So we saw the high yield spread chart. It's an absolute jargon of a symbol on the platform. It's CBUS 10-year spread, but it's looking at the essentially high yield bonds over like a risk-free type of rate. And that's been narrowing, which means that there's a perceived lower risk to holding those type of debt securities. So typically when this spread is narrowing, that's a good thing for equity markets. We actually ran a piece and kind of put some quantitative color behind a falling high yield spread typically corresponds with good forward equity market returns. So this is a chart that doesn't jive with a lot of the bearish sentiment that's out there right now. Of course, there's some rebuttals about Fed intervening and so on and so forth about times in the past. But in terms of what the chart's showing and what you've seen historically, this is a pretty good development to see.
Yeah, and 2 consecutive sell signals there, really kind of just series of lower tops, lower bottoms. So
pretty clear rollover. I think it is oversold right now by a pretty historic margin. So again, maybe there's some mean reversion there, but overall, this looks to be in a downtrend, which is positive.
Cool.
All right, what else you got? Oh yeah, one more thing report wise, and then we can get into your fantasy thing that I don't understand. But so one other thing I put in the report that I wanted to mention, and a lot of people are talking about, is crude oil that broke out of this pretty notable trading range. Also overbought right now, but I mean, should that pull back to the mid 80s, 84, 83, that old resistance, that would look really healthy. Energy equities have been participating nicely. You have XLE coming up to its all-time chart highs, looking really strong. Honestly, I think if you break above those all-time highs for XLE, that could be a really strong case.
Yeah, and you just had those production cuts as well from a kind of a fundamental perspective. So those are kind of a fundamental catalyst too. So.
Yeah, commodities definitely tend to be mean reverting and very sensitive to that supply demand balance, which is what we talk about for stocks. Supply and demand for stocks drives prices. I think you see that really clearly in the commodity market, where if there's any hindrance to supply, prices typically go up. If there's an a high amount of demand price. It's I think much more cut and dry than some of the equity movement.
Right. And you'd say for on one side of things for energy, right, you're exiting the summer months. People typically travel a little bit more. So there's one side, but then
There's
you're
some
all,
seasonality
but then
there,
you're
yeah.
entering, maybe you can say fall, but you're entering probably
Mhm.
slightly colder months. So there's a different type of energy based stuff, but there's always going to be a push for demand in
Yeah.
some shape or form.
Yeah. And there is some actually pretty interesting seasonality about crude oil. I put that in the report a few weeks ago. So you want to check that out in the all section. Probably worthwhile too.
One other thing before we jump into the fantasy football kind of fun adage at the end, we also saw MTUM pick up. We are momentum based shop, right? So should mention the world's biggest momentum ETF, MTUM, move back into a positive trend on its default chart. We've seen momentum really struggle, flounder for the past 8 months or so. We put a couple pieces in the report about why that is. I think really quickly, it's just the fact that you saw 2022's losers, tech mostly, be 2023's winners, 2022's winners being energy, staples, utilities, be 2023's losers. So that rapid churn is just a nightmare for momentum. Nonetheless, we're seeing a slight pickup for momentum as technology and industrials really continue to establish themselves at the top. So that's a nice kind of point there.
Yeah, that is a good point because momentum's buying the winners. So it's finally latched on to this year's winners. Now, if this year's winners roll over and then energy surges back to the top, we have seen a model or two buy energy, which is noteworthy. But if you see energy resurge completely and all these others old losers start to perform again, that's just going to be another headwind for momentum. But as it stands now, the momentum landscape is improving. The winners are outperforming the losers, and that's something that we like to see for sure. And the MTUM call out is definitely notable.
Sure. Okay, we'll jump into the kind of the fun last portion. For all you football heads out there, of course, it's the first week. If you had a fantasy draft this weekend, you probably are familiar with Situm or Stardom Situm, which is where we take a look and somebody tells you, hey, start this guy, sit this guy. So we're going to do a Nasdaq Dorsey Wright Stardom Situm for the sectors today. And I'm going to start here.
What do you think about these ideas?
I just randomly.
Just driving home. And
yeah, I'm like, that'd be fun to do. I was actually just like sitting there at my desk last night. I was like, that's going to be a winner for the podcast tomorrow. But
you gotta do something else.
Yeah, I know. But my stardom, talking about crude, the backdrop there, my stardom for this week is this guy was a winner last year, right? All throughout 2022. I mean, he fell off a little bit throughout 2023, but we've really seen him pick up. He's been practicing, he's been putting in his time, he's been, putting extra minutes in off the field. We're going to be looking at energy just in general. It's really stormed up in the Dolly rankings, stormed up on the asset class group scores page, taking a look at XLE, moving towards those all-time chart highs. I think energy is a stardom right now. On the contrary, my Situm, this guy has really just sat in the middle of our rankings for quite some time now, really broken down quite for over the recent past. And somebody I think with this breakdown, I don't want to have in my starting lineup, and that's going to be healthcare. We're going to throw up a chart range for the average healthcare fund score right now, topping out for the last year at around 3.75 and bottoming out at around 2.5 or so. Recently broke through that bottom range. So for the past year, at least kind of an intermediate term score for healthcare, breaking down to the downside. And I don't like to see that for healthcare.
Yeah. All right. Well, I'll participate in your fun as well. If I had a stardom, it's going to be industrials. They've been really strong at the top of our sector rankings, whether it's Dolly, group scores, really good participation beneath the surface. I was looking at XLI earlier as well. That's broke out to new all-time chart highs, just pulled back to old resistance. So that still looks healthy to me. If I just said them, it's going to be consumer staples. We saw non-cyclicals / staples fall in our Dolly ranks over the past week, moving into really the bottom half of the rankings. That's, I think, maybe broader, probably good for the market. It's a typically defensive sector. So I like to see staples weakening and rolling over relative to everything else. But if you're a consumer staples investor, that investable universe is getting pretty narrow. So I rather look for other sectors with a lot better participation.
Discretionary looks somewhat strong. I mean,
Yeah.
at least in comparison to,
Yeah.
and I think it also goes that both of our SITMs were more value focused names.
Yeah, there's the more healthcare has a defensive tilt.
Defensive. Yeah.
Non-cyclicals has a defensive tilt. I think if you did run a style analysis, it'd probably be more closer to value or maybe quality even. Value
Yeah.
probably. Yeah. So I agree with those, and I think that's a good way to end the pod.
Perfect. Well, listen, I hope everyone has a wonderful weekend, a safe weekend, and we will not see you next Thursday.
No, we won't. Announcement is that we're not going to be doing the pod next week because we will have our in-person Vegas symposium. So hopefully we'll talk to you there. As a result, like I said, no pod next week. We're also not planning to do our weekly rundown either, because that's going to be our travel day for the team. But if you do want some more media updates, Miles and I will be on the morning updates most days next week, David as well. So that's going to be our form of communication along with the usual daily report.
Perfect.
Cool. So now I think we're officially done.
Yeah. Yep. See y'all next time.